Hello, everybody. My name is Paul Buitink, and welcome back to a new episode of Reinvent Money. Today with my guest, Tavi Costa, portfolio manager at Crescat Capital. Please smash that subscribe and notification button so you won't miss my videos about macroeconomics, precious metals, crypto, and investing. Hi, Tavi. Good to see you.
Hi, Paul. How are you?
Yeah, not too bad. Let's dive right into it. You tweeted on the 5th of April that the Fed went from being the biggest buyer of treasuries to now a seller. What is going to be the consequence of that for US interest rates and the yield curve?
Well, I have a very strong view about this, actually. You look at the 10-year yields charts, especially going back to a few decades, and you see a downward channel of that instrument trading in a very tight channel over the years. And every time it hits the upper part of that channel, we tend to see some sort of economic recession or just a downturn, some sort of significant slowdown as well. Look, I'm of that view. However, I do think that what's happening in the supply side will actually cause a problem that we've seen perhaps back in 1973, 74, when yields were actually rising and at the same time as the economy was, or maybe leading up to a major downturn in the economy. And so I think we're in a similar position where I'm concerned about when I look at the different buyers of treasuries. There's, you can break down into just simple parties. First, you have the Federal Reserve, which was buying 40 to 50% of it. They are now want to become sellers. Number two, you have U.S. banks. U.S. banks have not been picking up the slack recently. They've been buying, used to buy over 110%. That was their peak in the last months, 110% of net issuances, meaning they're buying more than what's been issued. And now they're buying close to 20%. And foreign institutions, after what we saw with Russia and Ukraine and the sanctions on reserves and so forth, well, I think that's also changing the game when it comes to the new demand for a potential demand for treasuries. So I am questioning all those issues from a demand and supply side. I think inflation is more sustainable than most believe as well, and which means I also that will continue to pressure yields to be higher. And when you look at the Treasury curve today, just my final thought is that basically the entire curve all the way up to 10-year yields is lower than what the Fed dots are for 2023, which is 275. So if the Federal Reserve wants to take up short-term rates significantly from here without inverting the yield curve, they have to allow 10-year yields to rise. So I think this is an unpopular opinion, but I do think that even the Fed wants 10-year yields to rise a little bit. Now, do I think it's going to get to unsustainable levels where they have to come in and do yield curve control? Yes, I do. But we need to see that first. So I've been saying, wake me up when we hear any Fed member start talking about yield curve control, some sort of a way of capping yields in the long end. And I don't think we have heard that yet.
And what is that unsustainable level where they need to start implementing yield curve control?
I get that question a lot. And I got to say, I don't think we need to answer that because I don't know the answer for that. And I don't think anybody does. We can guess 3, 3.5, 4. The Fed members are very vocal and you will hear it. You will hear from one or two of those guys saying, look, I think we got to do something about long-term yields. We got to keep, well, the BOJ already came out and said that about their own JGBs getting a little bit out of hand relative to where debt imbalances are domestically. So can we hear that? And by the way, watch what happened with the Japanese yen relative to gold. You can see it as well relative to the dollar. It's breaking a structural resistance over many, many, many decades as well. And so I think we're going to see something similar here in the US, inevitably. But I am going to be short treasuries until I hear that tune changing from policymakers. I haven't heard that. The Fed is very focused on restoring their credibility when it comes to inflation at all costs, almost. Meaning maybe they want, you saw Bill Dudley coming out with, maybe saying that the Fed wants the equity markets to decline, and wants to force equity markets to decline, to slow down the economy. maybe that's a possibility. So I'm very focused on being short treasuries of the 10-year, especially because I think we're headed much higher. And once we hit those levels where it starts to bother things, starts to bother the economy, the GDP has to grow to a certain level just to pay down interest payment. They're going to be vocal. Trust me, it's not going to be just a one and done. Now we're going to come up with, no, they're going to be very vocal. They want to kind of warn that this is coming. And so once that happens, I'm going to change my view. But I haven't heard any of that.
Yeah, but yield curve control is just a fancy name of financial repression, right? It's in a way it's theft, because you don't let your citizens be able to save money in real terms, because in a yield curve control situation, inflation is higher than interest rate, like we had in the 40s, for example. But don't you expect citizens to revolt if we are in a prolonged period of yield curve control or financial repression?
I don't know. I think it might lead to unintended consequences, but at the same time, what is the alternative of that? Letting 10-year yields to rise? What is that going to do to mortgage rates? The majority of, you look at the lower classes, what do you think lower classes own? Real estate. It's a significant part of their balance sheets. And so, would they be okay then just hitting the housing market? I don't think so. I think we're in a peak inequality problem where it's almost a national defense topic when it comes to how strong housing markets have to at least be in order to not see what happened after the global financial crisis, when the lower classes lost close to 80+% of their net worth. Do we want to go there again? I don't think so. So the alternative is rough. And yes, we will see a lot of unintended consequences from yield curve control. There's another question. Will yield curve control even work? I don't know. And it might not work this time. And so.
And why won't it work possibly?
Well, historically, we had issues seeing some of that work in the past. And so, especially back in the 50s, you see 10-year yields, just look at the long end. During those times, it was hard to cap it after all it happened. So I think there are questions about the efficiency of the tool as well, and we may see something different at this time as well when it comes to some different way of doing this. But I think ultimately we're going to go there, and that's what's going to drive gold to that violent move to the upside, in my opinion. That's what's going to take gold to well above $3,000 an ounce and so forth. I don't think we're too far from that. So the accumulation of assets that will perform well, I think we're at that process. I mean, if I see, the decline of assets that I think will perform well in this environment of a cap yield or a attempt to cap yields, I think will be important, because inflation, yes, will be cyclical to a certain degree. But I think the secular shift is that inflation will be higher, not lower. So, we may see, let's say, a downturn in the economy driven by higher yields may hurt inflation a little bit. But does that mean inflationary forces won't continue to infiltrate the economy over time? I don't think. I think we'll continue to see that. So, it's more of a short-term versus long-term mentality type of question.
So you don't buy the narrative that inflation is transitory and that as soon as the war is over and supply lines are restored, that prices can go down again? And also the argument on top of that, which I also hear from, for example, Jeff Snyder, that just look at the yield curve in the far end, people and companies and bond traders aren't expecting that much inflation in the future. You don't buy the narrative then?
I respect the views on the deflationary thesis and so forth, but I think we've been conditioned to think that way because of what happened in the last decades. And it's important to note the structural changes happening in the economy. Number one, wages and salaries. It's hard to reverse a trend that already started where people are getting paid more than they were 4 to 5 years ago. You look at, from even a standpoint of minimum wages, right? I mean, all that is growing. When I moved to the US, minimum wages, I got paid $7 per hour for minimum wage, $7.25. Today, minimum wages are low, but when you look for what companies are paying to attract people, they're paying $15. That's double what I used to get paid. So things are changing. I mean, this is important. If you're not, and I feel like the majority of people that have the deflationist type of view are just not in the real economy. I mean, go ahead and hang out with people and talk to your friends and ask them what's happening. I mean, everyone is demanding higher wages. It's not too hard to do that, Or second thing, the chronic underinvestments in natural resource. Do you think you're going to fix that in 5 years? I mean, do you think you're going to find a large deposit of copper that will help the green revolution? Are people out of their minds? I mean, do they not know that we don't even have enough geologists? It's not even about capital. We don't have the labor to do it. So I'm questioning all those things. The third thing, the reckless amount of fiscal spending. We've seen now the issues happening in Ukraine and Russia. Okay, well, do you think military spending is going to be lower or higher? Do you know how much it used to be just in the 70s? About 9% of GDP. We're at like 1.5% to 2% today, historical lows. What if we just see it going up to 5% or 6%, which I think it's totally plausible. So, I think that will change. So the pressure to fiscal spending at a time when we have labor markets as strong as they are today, that's an inflationary mix. And let me just point out one more, because I think it's even more important. What about deglobalization, geopolitical tensions? Do you think a U.S. company today setting up their businesses in the U.S. will make a decision of creating a relationship with China and having the manufacturing plants in China and making that decision for the next 3 to 5 years? Do you think a company will do that? I don't think so. And so we're probably going to bring it back to the US. Economies are not going to be as globalized as they have been. And if that's the case, it means non-residential spending when it comes to building up factories and things in the US. That's also creates demand for materials, right? Cost of commodities and so forth. And so a lot of things to think about, but those are bigger trends to me than this whole idea about technology is deflationary and other things that are other folks referring to. The aging demographics might even play as an inflationary part of the thesis, not deflationary. So I don't know. I'm really not buying into this continuation of the trend that we've seen in the last 3 decades.
Right. So maybe markets are wrong in that sense. And also what I believe is that it could also be that quite a few institutional players have to buy those bonds because of Basel and other regulatory requirements, thereby suppressing the fair value of those instruments, right? But eventually that force will be smaller than the market forces that it will eventually drive up the yields of those securities because of inflation and because of all the arguments that you just mentioned. But you also believe that regulatory requirements also play a role here?
So, well, if you think about the 40s and where banks were buying a lot of treasuries, and the biggest, I hear that argument a lot and it's true, but the other buyer of treasuries was the US households. They were buying the war bonds, what they called at the time. Do you think we're going to see that today to the same degree? I don't think so. I really don't think we're going to see much of that. And I can change my view if I think that's going to happen, but I'm just not seeing it.
And so far you've been right? Because inflation stays high, is getting higher every time, and also bond markets are crashing. So your short position is yielding you some profits, I would assume.
Yeah, it's been great so far, knock on wood. And I still think, I used to say, forget a 2.5% and 3%. I would suspect the Fed is going to speak out, and I would be out of that trade. Have we heard a word about this? No. And so what does it mean? I mean, I think yields are headed higher. And what does it mean to technology companies? What does it mean to cost of capital in general, to junk bonds? Well, I hear this all the time. Well, junk bond yields have been low because bankruptcies have been very low. Why do you think bankruptcies have been very low? Well, because the government has been financing this and not allowing companies to go bankrupt. Will the government continue to do that? going forward. Okay, if they do, that means higher fiscal stimulus. So, and it's inflationary too. So it's like, I feel like for a person who is carrying a book as heavy as I am in gold, silver, commodities in general, US Treasuries is perhaps the best hedge I have, being short US Treasuries. So, I think it's just a smart hedge. That's all.
And do you believe yield curve control in the US will also accelerate the de-dollarization for the dollar as a world reserve currency?
Look, I think that's a very big question, with a lot of ramifications and a lot of angles that you can go into. I'm of the belief today that I still think the dollar is the best alternative. Now, does it mean we can see a more disintegrated monetary system where settlements of things can happen in more local currencies rather than dollar terms, and that would impact the dollar? I think it's a possibility. I think that the bigger question to me, even, I don't know if how you could really capitalize on that idea. But one of the things you could capitalize and adds to the Treasury short thesis is, well, look, we've seen this kind of crypto revolution happen, questioning the credibility of fiat currencies and the lack of anchor of a tangible asset that backs up the value of a fiat currency. And so, what do you think this is going to turn out to? It really is going to revolt people to ask central banks to improve the quality of their international reserves. And I think we're going to see gold playing a bigger role than treasuries. And so when I look at the chart of 10-year yields versus gold back in the 70s, where both went up together, they're actually extremely correlated. People like to talk about real rates being more correlated than nominal rates to gold. In the 70s, it wasn't, meaning people were selling treasuries to buy gold. And so that change in capital allocation was what caused both of them to be correlated. I think we can see that today. And that's why I call it a smart hedge, because I think there's a very good probability we may see that.
Yeah. And what do you make of Zoltan Pozar's argument? I'm sure you've read his articles where he says that the commodity producers and exporting countries would prefer stockpiling on gold and other commodities instead of having treasuries, especially in a situation of yield curve control. They will lose purchasing power if they keep their reserves in dollar treasuries, also given the fact that they can be frozen at will. So what do you believe, what do you make of his argument that there will be stockpiling of commodities and gold taking place in the future?
No, I'm obviously biased and I loved when I heard that, but taking my biases out of the picture, I think that's understandable, right? And I think it's probably a good case for it. It just feels like you're just adding to that case for shorting treasuries for longer, for higher yields. From so many perspectives, from foreign institutions to, you talked about banks. Well, look how much banks have been, you said that banks and other institutions may be forced to buy treasuries, and some of them for regulatory purposes already have had to buy treasuries. And we've seen that reduction of their purchases, which is kind of interesting, but let's just say they're forced to do more. Well, look, the US banks today lend more to the government than to businesses, to levels we haven't seen since the 40s. So are they going to do more of that? Maybe, that's okay. It's almost being a state-owned institution if that's the case. But look, I don't know if those things are going to play out, but I think they're all questioning the where yields are today. If there's a possibility they could go significantly higher from here, and I believe that that's going to happen. So again, wake me up when we hear yield curve controls being the narrative again. I think 10-year yields will be the narrative in the next 6 months, even less than that, because a breakout from that channel, the downward channel I'm referring to on 10-year yields, would probably accelerate that trend to the upside. And if we see that, we can see very quickly 3.5% and 4. And I think that would start bothering them. Now, again, I don't need to be right about this. If they don't start getting bothered until 5%, no, I'm okay with that. I'm staying on my trade until I see that tune change.
Right. And you're also a big fan of silver. Why?
Well, I think there's a lot of reasons to own silver. If you're a believer that we're in the beginning of a bull market for gold, or not beginning, but let's say you think gold has had a much higher from all the things we just discussed. I think the gold to silver ratio to be at around 70 or so, give it or take, it's just not right. I think we're going to see silver outperforming gold over time. It's the riskier part of the market. It's the alpha and the beta of gold in a way when you see this types of moves. And on top of it, it's a monetary asset, an inflationary hedge. You looked at other inflationary periods, silver have done very well. It fits into the green revolution in a large way as well. And just calculating the value of silver relative to many things, such as commodities and the monetary base and the money supply and equity markets and gold, everything points to me that silver is historically undervalued. So to me, I think silver is one of the cheapest metals on earth. I've said that many times. And I think it's an incredible time to be accumulating assets into it. It's very hard to find primary assets of silver. I know the supply is extremely constrained. It actually comes from regions that have a lot of geopolitical problems, from Peru to Mexico and so forth, and even Bolivia. And so, it's an incredible asset to own for the following years, in my opinion, and I think will surprise a lot of people.
And do you believe the paper price is being suppressed?
I don't have a strong data to support that. Do I think it's weird what we see on Sunday nights and when silver seems to be doing well, all of a sudden you get whacked on that trade? Certainly is questionable. But look, I focus much more on the macro thesis than that, because I think if you're a big believer that silver is manipulated, you shouldn't be buying in the first place. Then you should be just, doing something else with your capital. And it's not my view I think that the macro case is much more relevant. So that's where I focus. And I think eventually or inevitably we'll see silver prices at much higher levels.
And what's your view on Bitcoin?
I think Bitcoin is an alternative for the monetary system. As I said before, I think Bitcoin and crypto have created one of the biggest libertarian political movements we've seen, and certainly is going to force banks or central banks to improve the quality of their international reserves. Will large central banks buy Bitcoin rather than gold? I think as of today, no. Maybe in the future. I don't own Bitcoin anymore. I used to own Bitcoin, and what I think is, I just really, I'm trying to find a very asymmetric and contrarian way of playing alternatives of the monetary system that may perform very well. And even gold seems to be, I think a lot of people would agree with the gold thesis and the big miners. So that's why I've been buying exploration assets with high quality deposits that can really perform well with the minerals in the ground that have the leverage to gold and silver prices in a big way, even copper as well and other base metals. So I'm more focused on things that are not priced in, and I think there's enough smart people in this industry of the crypto space in general, and it's hard to find more inefficiencies because of that. And I'm sure there are inefficiencies for the very, very intelligent ones. But am I the guy that will come into the space and be able to run and find the best opportunities? Probably not. I'm probably not the right guy. So I respect the thesis. I watch, I listen to it. I read about it. I try to study the market, but I'm much more focused where I think that the generational wealth will be created, which I think it's really on very illiquid today, but also with very high quality assets in more early stages of exploration that I think will be more interesting.
Right. Well, let's pick one question we got on Twitter. We had a few questions, but time is a bit tight today. That's my bad. But let's pick one that's also related to mining shares. So we have Wouter Brakhoven asking, we had years of low inflation, now we have high inflation. Does this not benefit the royalty and streaming companies more than the gold miners as their margins get squeezed more than the royalty companies?
Probably. I think there's a case for that, but now you're talking about producers. I don't own many producers. I own exploration assets, and exploration assets they are getting somewhat squeezed, but they don't even have margins, right? You're raising capital to explore, and so they're not so much linked to material costs. Energy costs is not as impactful as for open pit production per se. So I'm very interested in buying the metal in the ground, right? So if you're buying the metal in the ground and you have a run up in gold and silver prices, the leverage you get from those assets relative to the underlying commodities is absurd. So to me, that's the interesting part of the thesis. I think that argument only increases the case for owning exploration assets. For me, and at a time when nobody is paying attention to this part of the industry. So focus on where I think we are in the business cycle in the US. I think we've seen most of the great news in the US economy. And I think we're headed to a deceleration of growth, to say the least. But I think it could be a recession as well. So I've been focusing on piling up all these recession indicators, from yield curve to initial jobless claims to unemployment rate, everything that looks really, really good today that can improve much from here. And that means we're going to see that inflection point of things getting worse. And so margins at peak, and you're seeing earnings at peak. And so when are things going to turn? I think we're getting very close to that. So that's what I've been watching.
And people should just follow you on Twitter at Tavi Costa, because you support all your research with great charts, which makes it even more convincing. So people, please follow Tavi on Twitter, where you can enjoy all his research. And let's do this again in the future, Tavi. I'm sorry I'm a bit tight on time, but I have to pick up my son from daycare, and I can't let him wait for too long.
Good for you.
But thanks a lot,
you,
Tavi, and keep in touch.
Will do.